The investor who bought Dividend stocks in 2015 and the one who bought them in 2025 will retire with wildly different amounts of money. Not because the market changed, not because Dividend ETFs got worse, but because one of them understood something the other completely missed. And after watching Dividend investors for a decade, the wins, the disasters, the quiet millionaires nobody talks about, I can tell you exactly what separates them. Most people stumble into dividend investing because someone told them it's safe. They hear passive income and think easy money. Then they chase the highest yield they can find, watch their portfolio bleed for 3 years, and conclude that dividends don't work. Meanwhile, someone else might quietly turns $50,000 into $500,000. Same strategy, same market, completely different outcomes. Quick disclaimer: I'm not a financial advisor and this isn't financial advice. Always do your own research before making any investment decisions. Today, I'm breaking down the 3 costly patterns I've watched destroy dividend portfolios, the specific mindset shift that separates successful dividend investors from everyone else, and the exact approach that's historically turned modest investments into serious wealth-building engines. But here's what makes this different. I'm not going to tell you which ETF is best. I'm going to show you how to think about this entire space so you can make that call yourself. Let's start with the mistake that costs people the most money. And ironically, it's the one that feels the smartest when you're making it. Chasing yield. It sounds so logical. If I want income, shouldn't I buy the thing that pays the most income? A fund yielding 8% obviously beats one yielding 2%. Basic math. Except it's not basic math, it's a trap. Here's what happens in practice. A stock or ETF shows an unusually high yield. New investors pile in. But that yield is often high because the price collapsed, which happened because the underlying business is deteriorating. The dividend gets cut, the price falls further, and the investor who bought for yield ends up with neither yield nor growth. I've watched this pattern repeat with individual stocks, with sector funds, with high-yield ETFs marketed specifically to income seekers. The allure is always the same: big numbers on a screen. The outcome is always the same: disappointment. The investors I've seen build real passive income streams over a decade. They understood something counterintuitive. A lower yield today can produce more income tomorrow. Not might. Has historically done so, repeatedly. Take the Vanguard Dividend Appreciation ETF, VAJA. Right now it yields around 1.6%. That's not exciting. That's not going to pay your mortgage next month. But VIG only holds companies that have increased their dividends for at least 10 consecutive years. The companies are screened specifically to exclude the highest yielders, the ones most likely to cut. Compare that to what happens when you buy an 8% yielder that cuts its dividend by 40%. Suddenly, that exciting yield becomes 4.8%, lower than what you would have gotten from a boring fund that kept growing its payments year after year. Harry learned this the expensive way. Back in 2018, he allocated $30,000 to a high-yield fund because the monthly income looked incredible on paper. Within 2 years, 3 of the fund's largest holdings had slashed their dividends, and Harry's income dropped by more than a third. Meanwhile, his colleague who bought VIG at the same time saw her income actually increase, even during the market turmoil of 2020. Her yield on cost, meaning the yield based on her original purchase price, eventually exceeded what Harry was getting from his supposedly higher yield fund. This is the first lesson. Yield is not income. Yield is a snapshot. Income is what actually shows up in your account over decades. And the path to maximizing lifetime income runs directly through dividend growth, not dividend yield. But here's where it gets interesting. Because dividend growth itself has tiers, and most investors never graduate past the first one. The Schwab U.S. Dividend Equity ETF, SCHD, has become enormously popular. Nearly $70 billion in assets. A yield around 3.9% as of late 2025. It holds companies that have paid dividends for at least 10 years and scores them on quality metrics. Cash flow to debt, return on equity, 5-year dividend growth rate. It's a good fund. Solid approach. But SCHD had a rough stretch recently. While the broader market surged on technology momentum, SCHD underperformed significantly because its methodology specifically excludes many of the high-growth names driving market returns. In 2024, SCHD returned about 11.6%. Respectable. But it lagged the S&P 500 by a wide margin. Here's what separates experienced dividend investors from beginners. The experienced ones expected this. They understood that a fund focused on high-yield value stocks will underperform during momentum-driven tech rallies. They also understood that SCHD would likely outperform when that momentum reversed, which it has done historically in multiple periods. The beginner sees the underperformance and panics. Sells SCHD, buys whatever's working now, locks in the loss, misses the recovery, repeats the cycle with whatever strategy underperforms next. This is the second lesson. Dividend investing is a long-term investing strategy that requires accepting short-term underperformance, not tolerating it, expecting it, building it into your mental model from day one. Now let me show you something that connects these ideas. There's an ETF called DGRO, the iShares Core Dividend Growth ETF. It yields about 2.1%, lower than SCHD. It tracks the Morningstar US Dividend Growth Index, which requires companies to have a history of increasing dividends with sustainable payout ratios below 75%. Crucially, it excludes the highest-yielding stocks entirely. Over the past 10 years through late 2025, DGRO has delivered an annualized return around 12.7%. That includes dividends reinvested. An investor who put $10,000 into DGRO a decade ago would have roughly $34,000 today, assuming reinvestment. But here's the number that matters more. DGRO's dividend per share has grown at approximately 7 to 8% annually. That means if you bought DGRO 10 years ago and held, your yield on cost isn't 2.1% anymore. It's closer to 4%. And climbing every year. This is the compound interest engine that experienced dividend investors understand. The yield you buy at isn't the yield you keep. If you choose dividend growth over current yield, your future income can exceed what any high-yield fund would have paid you from day one. Let me put actual numbers to this because the math gets striking over long periods. Harry, same Harry from earlier, now 10 years wiser, puts $20,000 into DGRO with a 2% starting yield. That's $400 in year one. Assuming the dividend grows at 8% annually, by year 10 he's receiving $863 per year from that same $20,000 investment. His yield on cost is now 4.3%. By year 20, that annual dividend payment has grown to over $1,800, a yield on cost exceeding 9%. Meanwhile, someone who bought an 8% yielder that never grows, they're still receiving $1,600. They started higher but got passed. And that's assuming the high-yield fund didn't cut its dividend, which historically happens more often than most investors expect. This brings me to the third and most important lesson, the lesson that took me years of observation to fully internalize. Dividend investing is not about dividends. I know that sounds ridiculous, but hear me out. The best dividend investors I've watched don't think about dividends first. They think about business quality first. They ask, is this company likely to exist in 20 years? Is it generating more cash each year? Does management actually prioritize shareholders? Dividends are a symptom of those qualities, not the goal. When you focus on dividends themselves, yield, payment dates, income projections, you get distracted from the underlying reality. You start optimizing for the symptom instead of the cause. The funds that have historically performed best in this space, VIG, DGRO, even SCHD at its best, work because they filter for business quality using dividends as the lens. 10 consecutive years of dividend increases is a proxy for stable, profitable businesses. Payout ratios below 75% signal financial health. Cash flow metrics indicate real earnings, not accounting tricks. When you understand this, the whole investment strategy clicks into place. You're not buying income. You're buying ownership stakes in excellent businesses that happen to share profits with shareholders. The income is a byproduct of that ownership. Now, let me address something practical because I know how people actually behave. Most investors don't have $50,000 to deploy at once. They're adding money monthly or quarterly, building positions over time. And this is actually an advantage. one that new dividend investors rarely appreciate. When you invest consistently regardless of market conditions, you automatically buy more shares when prices are low and fewer when prices are high. This is called dollar cost averaging, and it smooths out the volatility that causes emotional investors to make terrible decisions. Combined with dividend reinvestment, automatically using your dividend payments to purchase additional shares, you create a self-reinforcing wealth machine. Each quarter, you add money. Each quarter, your dividends buy more shares. Each year, those dividends increase. The compounding layers on top of compounding. Here's how this has historically played out with SCHD specifically, according to various calculators and backtests. An investor who put $10,000 into SCHD 10 years ago with dividends reinvested would have approximately $42,000 today. Without reinvestment, just taking the dividends as cash, that same investment would be worth around $36,000. The reinvestment alone added over 16% to the total return. But add monthly contributions of just $100? Now you're looking at considerably more depending on when you started. The combination of consistent investing plus dividend reinvestment plus dividend growth is how ordinary people have historically built extraordinary retirement savings. Let me give you a framework for actually choosing between these funds, since that's probably what you're wondering. If you're young, have a long time horizon, and prioritize total return over current income, VIG makes a compelling case. Lower yield, higher growth focus, exceptional track record of holding up during downturns. It's beaten its category average on a risk-adjusted basis over long periods. If you want meaningful current income while still maintaining growth, SCHD sits in that sweet spot. Nearly 4% yield with double-digit historical dividend growth. More value-oriented, which means it may lag during growth rallies but has historically recovered. If you want the middle ground, balance between growth and income with broad diversification, DGRO offers around 400 holdings with solid dividend growth metrics and low fees at 0.08%. None of these is wrong. The wrong choice is chasing whatever performed best last year, or panic selling when your fund underperforms for a quarter, or, worst of all, buying high yields without understanding why they're high. Here's what I want you to take away from 10 years of watching this space. The dividend investors who succeed share 3 traits. First, they understand that yield today means nothing compared to income over decades. They buy growth, not yield. Second, they expect underperformance and don't react emotionally when it happens. They know value and growth take turns leading. Third, they think in terms of business ownership, not income generation. The income follows the ownership. The investors who fail all make variations of the same mistake. They treat dividend investing like a savings account, something safe and predictable and boring. It's not. It's equity ownership with all the volatility that implies. The dividends don't protect you from drawdowns. They just give you cash flow while you wait for recovery. If you can hold that complexity in your mind, that dividend investing is simultaneously a path to financial independence and a strategy that requires genuine patience. You have a realistic shot at success. Harry figured this out eventually. The $30,000 he lost chasing yield taught him more than any book could have. Now his portfolio sits quietly in VIG and DGRO, compounding year after year, dividends reinvesting automatically. He checks it quarterly instead of daily. His yield on cost climbs every year. And in another decade, his passive income might likely exceed his expenses without selling a single share. That's the destination. The question is whether you're willing to take the boring road to get there. If this changed how you think about dividend growth and portfolio diversification, drop a comment. And if you want to see how specific ETF combinations perform in different market conditions, the actual numbers, not just theory, that video is right here.